judges, we have Park University for you next.
Okay, and we're just supposed to talk, is that the
Yep,
deal?
go for it.
Is this interactive? Do we get to talk back and forth with the judges on?
You do your presentation first and then there'll be Q&A.
Okay, well, basically, I think our consensus is we disagree with the assumption of the question, which is to say, not whether we should bail them out or whether we should not bail them out, but in essence, the fiat money system is unstable. In other words, the Federal Reserve dollar system, the fiat money system. So in effect, what we are doing, if we choose to bail out SVB, we are saying, okay, this game of cards that we have sitting in the air, all these balls that we're juggling, well, we're just gonna keep juggling them some more. So we can either do that, or, and in doing so, basically, if we're going to do it, what we're going to do is print a bunch of money out of thin air. We're just going to hit some digits and create out all this money out of thin air. We're not actually transferring value or restore money. On the other hand, if we do not choose to bail them out, then the confidence game of the bank is up. And so everybody has a run on their money and they start running out. So the question is, do we bail out SVP and keep the game going and hope that we can continue confidence in the rest of the American economy? Or do we have a repeat of what we had in 08 and 09 when Bear Stearns and Lehman Brothers and Washington Mutual and the insurance company and Fannie Mae and Freddie Mac and everything went down the tube and the money market accounts froze up and people couldn't write checks and business couldn't be transacted? So basically we are giving a set of bad choices. Jump in.
Well, personally, I would feel that, like you said, we're dealing with two bad choices either way. I would go the route of maintaining the confidence of those debtors, although it may be at a disadvantage to us. At least in that sense, we can keep the institution that we've been supporting for years now up, and like I said, maintain that same confidence with them, give them their money back.
But we would wipe out the bondholders, the shareholders, and the execs. Basically make sure that the operating businesses could still make payroll and take care of their business and things like that. But in doing so, we're basically saying, okay, we're going to thereby cede to Washington even more, or Federal Reserve, more supervisory regulatory, because somebody's got to go in and make sure at these smaller institutions that they're being properly supervised. And oh, by the way, the Federal Reserve does bear some fault in this particular instance, because the Federal Reserve left interest rates too low for too many years, where it cost nothing to borrow, so SVB Bank then in turn went and borrowed at the long end of the curve and had 10-year treasuries yielding what, 1 or 2% or whatever it was, and then the Federal Reserve raises the interest rate to 4.5% or something like that over the course of 4 quarters. The bank should have probably mitigated those losses and done some better risk management and arbitrage and maybe sold some things at losses. But nonetheless, the Federal Reserve is partially at fault at it by virtue of the tightening cycle and by virtue of the lack of supervision by the San Francisco branch of the Federal Reserve.
Okay, ready for Q&A?
Sure.
All right.
Okay, so when you say you favor maintaining the confidence, in other words, if I read it correctly, that means bailing them out.
Yes, sir.
But the depositors only,
Yes.
Right, but
not the capital structure.
what will be the cost, in other words, in terms of cost to taxpayers and also for future healthy bank practices? In other words, what would be the deterrent? What would discourage banks from repeating this cycle, knowing fully well that the government is going to bail them out?
I feel like that would, you said deterring the cycle?
What would deter them from taking us back to what we had in 2008 and then 2023 and then So I'm saying, what will stop this cycle from repeating itself if we keep bailing them out?
I feel like that once again kind of goes back to the same concept of the fiat money not necessarily being a tangible, like valued item. I feel like we would honestly need to break down the institution we uphold at this point. After bailing them out, just have a change of mindset, really.
Another way that could be going, you could go about it is you could actually auction off the bank assets on the private market and then use the proceeds from those sales to pay for the account holders so that they would get their money, but the bank would be liquidated in the near future.
If we were to see a cascade of bank runs, would that change your policy recommendation? If we were to begin to see banks failing one after another?
Our contention is that if you do not take care of the depositors, that is in fact what would happen.
But suppose that does happen. What about the FDIC insurance? What if there's not enough money available?
It becomes a problem because they don't have congressional authority to go beyond the 250,000. My understanding is that they're trying to recover that money through fees that the FDIC is going to be charging its member banks, but that only works as long as there's enough banks that they can assess it among. Yes, sir.
Is there a bank that you would let fail?
Well, I think all banks should be allowed to fail insofar as the shareholders, bondholders, and officers are concerned. The question is whether or not we allow them to fail and let the depositors lose. And so therefore, at that point, you might want to take a look at the history of the banking industry itself, going back to the panics before the establishment of the Federal Reserve back in the late 1800s and the early 1900s, when J.P. Morgan, et cetera, stepped up to the bat and said, okay, let's bail these guys out. And, I think it was 1902 when that occurred, before the regional bank system came about.
For the deposit account holders, they're aware of the rule. Does their awareness of the rule, the $250,000 limit insurance, have any bearing on your decision whether to make them whole?
I suppose if I were the money god, then you might go in and say, well, perhaps we need to have a deposit level of whatever, 250,000 for individuals, and then have a higher operating limit for businesses. I don't know on that, but the problem gets to be if you've got a small business that's operating down the street, or where they've got 20, 30 employees or whatever it is, they may well have $500,000 sitting in the operating account for payroll. And so if you say, well, we already have a de facto situation right now, we do in fact, where we have about 7 banks nationally which are basically guaranteed as being too big to fail, right? We got J.P. Morgan, you've got Citibank, you've got Wells Fargo, and I forget some of the other institutions, Morgan Stanley, et cetera. So those institutions already have a government guarantee. So if you say to other than the 7, you say all these rest of the guys over here, okay, we're going to guarantee the deposits of you guys because you are systemically important. But because you are not systemically important, we're not going to guarantee any of you. So where do you think the deposits are going to go? And then we're going to have a concentration of power. And so then, do we like having one choice or 2 choices for cars, or 1 or 2 choices for phone service or for TV? What happens in a monopoly? What happens when you have a duopoly? or an oligopoly. So let's say we do not take those, we let those 250s over 250 fail. So in effect, basically what you're going to do is close 15,000, 12,000 banks across the country that hold deposits for small operating businesses, send them all to New York. And we'll have about 7 banks to choose from. And I'm sticking my nose here in this one. There's the ticker symbol, BIGB, big bank, and it has the systemically important banks. I think over the next 5 years, you'll see that the value of that ticker symbol will go up and outpace what you might see like the KBW, the regional banks, because you're going to see deposits flowing to the systemically important banks, which in turn will dry up capital for small businesses, for Main Street, for small towns like Ottawa and Leavenworth and other places, because the priorities of the folks that sit in the office at JP Morgan are not the same as the ones that are sitting out in Wichita, Kansas. Different set of priorities of who they're going to lend to.
So just to be clear, so you think ignoring the stated limit for SVB bank account holders will prevent deposits from leaving small banks and going to the systemically important banks?
I think if you, when you have a crisis, you have to make a change at times. And I think this would probably be one of those times you would have to rethink what those limits should be. But bear in mind, it's a contrived system based on fiat money. You know, the federal government doesn't have the money to pay its bills. We all know that. We expect the Chinese and the Japanese and everybody else to buy our treasury notes. So we print it, sell it, and hopefully they buy it, you know. But if the federal government had to live on their actual income, then we probably wouldn't have revenues to do half of what we do.
Good.
Thank you.
All right, thank you.